Get ready, because the crypto world is absolutely exploding with news, and you need to be in the know. We're diving headfirst into a market that's shifting faster than ever, with major players making bold moves and altcoins lighting up the charts. If you thought things were heating up, buckle up, because this is the information you absolutely cannot afford to miss. We've got the inside scoop on massive surges, strategic plays, and what it all means for your portfolio. First up, are we officially in altcoin season? We're talking massive gains, Bitcoin's dominance dipping, and one particular token absolutely skyrocketing thanks to a surprising partnership. This is the kind of move that could define the next market cycle. Then, we're heading to the stock market to see how major players are making strategic moves, with a look at how corporate adoption is changing the game for institutional investors. Plus, we'll break down the high-risk, high-reward world of Bitcoin treasury companies. You won't want to miss a second of this. Hit that like button, subscribe, and ring the bell so you never miss an update. Altcoin season ignites as Cronos skyrockets 120%. Get ready, because the crypto market is showing serious signs of an altcoin season, with investors shifting their gaze from Bitcoin to a host of other exciting digital assets. The latest data indicates a significant uptick in altcoin performance, with major indicators pointing towards a broader market rotation. This trend, often called altcoin season, is marked by a shift in investor sentiment and capital allocation away from the market leader, Bitcoin, towards smaller, more volatile cryptocurrencies that have the potential for explosive growth. The shift is clearly visible in market dominance charts. Bitcoin's share of the total cryptocurrency market capitalization has seen a noticeable decline, dropping from 65% in May to 59% in August. This reduction in dominance is a classic indicator that capital is flowing into alternative assets. Analysts suggest that favorable macroeconomic conditions, including easing inflation and the possibility of interest rate cuts from the Federal Reserve, are creating a fertile ground for this market rotation. Lower inflation rates tend to increase the purchasing power of investors, while the prospect of lower interest rates makes riskier assets, like altcoins, more attractive compared to traditional fixed-income investments. The overall market liquidity has also improved, coupled with a consistent growth in stablecoin issuance. These factors provide the essential fuel for altcoins to gain momentum. Improved liquidity means there is more capital readily available to flow into the market, and stablecoins offer a reliable on-ramp for investors looking to enter the crypto space or move between assets. This environment is particularly beneficial for altcoins, which often require less capital to see significant price movements compared to Bitcoin. One of the most dramatic examples of this altcoin surge is Cronos, CRO, the native token of the cryptocom ecosystem. CRO has experienced an astonishing surge of over 120% in the past week alone. This remarkable performance is largely attributed to a strategic partnership with Trump Media, the company behind the social media platform Truth Social. The integration of Crypto.com's wallet infrastructure into Truth Social, alongside the adoption of CRO as a utility token for various functions like rewards and subscriptions on the platform, has created a significant demand for CRO. This partnership exemplifies how strategic business collaborations can directly and powerfully impact the valuation of cryptocurrencies. Further evidence of this altcoin outperformance comes from broader market data. Over the last 90 days, a substantial majority of the top 100 cryptocurrencies by market value have outperformed Bitcoin. Tokens such as OKB, Arrow, and indeed Cronos, CRO, have posted some of the most impressive gains, with OKB up over 231%, Arrow up 158%, and CRO seeing a 96% increase. Even Ethereum, a major cryptocurrency often considered an altcoin in this context, has seen its value climb by 62% during the same period, underscoring the widespread strength across the altcoin market. As investors navigate this evolving landscape, the potential for significant returns during an altcoin season is a major draw. However, it's crucial to remember that altcoins typically carry higher volatility and risk compared to Bitcoin. Their performance can be influenced by a multitude of factors, including technological advancements, regulatory developments, and shifts in market sentiment. Nevertheless, with the current macroeconomic tailwinds and improving market liquidity, the conditions appear favorable for altcoins to continue their upward trajectory. But the market shifts aren't just happening in the altcoin space. Stay tuned as we explore how corporate America is making its own strategic moves in the crypto arena. We're diving into the Nasdaq debut of American Bitcoin and what it means for the mining sector. American Bitcoin makes Nasdaq debut amidst crypto mining evolution. The cryptocurrency mining sector is undergoing a significant transformation, and American Bitcoin's recent Nasdaq debut is a prime example of this evolution. This strategic move isn't just about listing a company. It's a calculated play designed to leverage mergers and acquisitions to navigate the increasingly complex and competitive landscape of digital asset mining. By combining forces, companies aim to achieve greater economies of scale, enhance operational efficiency, and secure a more robust position in the market. The backdrop for this debut is a mining industry that has matured considerably. Initially characterized by individuals setting up home rigs, crypto mining has rapidly professionalized. Large-scale operations, often referred to as mining farms, now dominate the landscape, requiring substantial capital investment in specialized hardware, energy infrastructure, and cooling systems. The profitability of mining is heavily dependent on factors like electricity costs, the efficiency of mining rigs, and the prevailing price of the cryptocurrency being mined. As the industry matures, consolidation through mergers and acquisitions becomes a logical strategy for growth and survival, allowing companies to spread fixed costs over a larger operational base and access capital more readily. American Bitcoin's strategy appears to be centered on this consolidation. While specific details of their merger-driven approach are still unfolding, the intent is clear: to build a more resilient and competitive mining entity. This could involve acquiring struggling mining operations, merging with complementary businesses to create a more diversified portfolio of mining assets, or integrating new technologies to improve mining efficiency. For instance, a merger could bring together a company with access to cheap energy and another with state-of-the-art mining hardware, creating a synergistic effect that boosts profitability for both. The decision to debut on the Nasdaq is also significant. Listing on a major stock exchange like Nasdaq provides increased visibility, access to a broader pool of investors, and a platform for raising further capital. For a company in a sector as dynamic and sometimes volatile as crypto mining, this kind of mainstream financial endorsement can lend credibility and attract institutional investment, which is crucial for funding the significant capital expenditures required. This move also reflects a broader trend of traditional finance intersecting with the cryptocurrency industry. As more institutional investors look for exposure to digital assets, companies that can offer a clear, regulated pathway to participate in the underlying technologies, such as Bitcoin mining, are likely to gain traction. American Bitcoin's Nasdaq listing positions it as a potential gateway for such investors, bridging the gap between traditional markets and the burgeoning crypto economy. The implications for the crypto mining sector are substantial. Increased consolidation could lead to fewer, larger players dominating the market, potentially impacting decentralization, although it also promises greater efficiency and stability. For investors, companies like American Bitcoin offer a way to gain exposure to Bitcoin mining without the direct technical complexities or capital requirements of setting up their own operations. However, the success of such a strategy hinges on effective integration of acquired assets, prudent financial management, and the ability to adapt to the ever-changing dynamics of the crypto market, including regulatory shifts and technological advancements in mining hardware. While some companies are strategically merging to mine, others are building their reserves. We're now turning our attention to companies holding Bitcoin on their balance sheets. What does the future hold for these corporate Bitcoin treasuries? Bitcoin treasury companies, a risky bet or the future of corporate finance? The strategy of holding Bitcoin on a company's balance sheet, often referred to as corporate Bitcoin treasury, has become a significant talking point in the financial world. Companies that adopt this approach are essentially betting on the long-term appreciation of Bitcoin, treating it as a reserve asset similar to gold or foreign currencies. This move represents a bold departure from traditional corporate finance, where treasury assets are typically held in stable, low-yield instruments. The allure for these companies lies in the potential for substantial capital gains, diversification benefits, and a hedge against inflation. But it also comes with considerable risks. The genesis of this trend can be traced back to companies like MicroStrategy, which began aggressively accumulating Bitcoin in 2020. Their rationale was rooted in a belief that Bitcoin offered a superior store of value compared to traditional fiat currencies, which they saw as susceptible to devaluation through monetary policies like quantitative easing. MicroStrategy's significant Bitcoin holdings and its subsequent price appreciation have served as a powerful case study, encouraging other corporations to explore similar strategies. These companies often justify their Bitcoin holdings by citing its scarcity, decentralization, and growing adoption as a digital asset. The potential upside for companies holding Bitcoin is undeniable. If Bitcoin's price continues to climb, as many proponents believe it will, these companies could see their treasury assets grow exponentially. This growth can bolster their financial statements, enhance shareholder value, and provide a significant competitive advantage. Furthermore, holding Bitcoin can be seen as a way to hedge against inflation and currency debasement, particularly in an environment where central banks are expanding their balance sheets. The digital nature of Bitcoin also offers advantages in terms of divisibility, portability, and ease of transfer compared to physical assets like gold. However, the risks associated with corporate Bitcoin treasuries are equally substantial. Bitcoin is notoriously volatile. Its price can experience dramatic swings in short periods, meaning a company's treasury could lose a significant portion of its value rapidly. Unlike traditional assets, Bitcoin is not backed by any government or central bank, and its value is primarily driven by market demand, sentiment, and adoption. This lack of intrinsic backing and high volatility make it a challenging asset to manage from a treasury perspective, as it introduces significant financial risk that can impact a company's stability and reported earnings. Accounting and regulatory treatment also pose complexities. Companies holding Bitcoin must navigate evolving accounting standards and regulatory frameworks, which can be uncertain and vary by jurisdiction. For instance, accounting rules can require companies to recognize unrealized losses if the market value of Bitcoin falls below its purchase price, potentially impacting reported earnings. Regulatory scrutiny is also a constant factor, as governments worldwide grapple with how to classify and regulate digital assets. Furthermore, the fad aspect is a valid concern. While some companies see Bitcoin as a fundamental shift in the financial landscape, others may view it as a speculative trend. If the price of Bitcoin were to decline sharply, or if its long-term viability were questioned due to regulatory crackdowns or technological challenges, companies with large Bitcoin holdings could face severe financial repercussions. This makes the decision to hold Bitcoin a high-stakes gamble. Ultimately, the success of corporate Bitcoin treasury strategies depends on a company's risk tolerance, its long-term outlook on Bitcoin, its ability to manage volatility, and the broader market and regulatory environment. While the potential rewards are high, the inherent risks cannot be understated, making it a strategy that requires careful consideration and robust risk management. Now that we've looked at companies holding Bitcoin, let's broaden our view to how corporations are adopting Bitcoin in general. We're exploring the new era of institutional exposure through corporate adoption. Bitcoin's corporate adoption ushers in a new era for institutional exposure. The increasing acceptance and integration of Bitcoin by corporations signify a monumental shift in how traditional finance views and interacts with digital assets. This growing corporate adoption is not merely about companies holding Bitcoin on their balance sheets. It encompasses a wider array of strategies, including accepting Bitcoin for payments, investing in Bitcoin-related infrastructure, and utilizing Bitcoin for cross-border transactions. This trend is paving the way for greater institutional exposure, lending legitimacy and further driving demand for the cryptocurrency. One of the primary drivers behind corporate Bitcoin adoption is the recognition of Bitcoin as a potential store of value and a hedge against inflation, similar to gold. As central banks globally have continued to engage in expansionary monetary policies, printing more money and potentially devaluing fiat currencies, companies are seeking alternative assets to preserve their wealth. Bitcoin, with its fixed supply of 21 million coins, offers a stark contrast to inflationary fiat currencies. Companies like MicroStrategy have been pioneers in this space, converting a significant portion of their corporate treasury into Bitcoin, demonstrating a strong conviction in its long-term value proposition. This has inspired many other publicly traded companies to consider similar moves, diversifying their treasury reserves beyond traditional assets. Beyond treasury management, corporations are exploring the utility of Bitcoin for operational purposes. Some companies are beginning to accept Bitcoin as a form of payment for goods and services. This not only caters to a growing segment of customers who prefer using digital assets, but also positions these companies as forward-thinking and technologically adept. For businesses operating internationally, Bitcoin can offer a more efficient and cost-effective method for cross-border payments compared to traditional banking systems, which often involve intermediaries, high fees, and lengthy settlement times. The peer-to-peer nature of Bitcoin transactions can streamline these processes. The involvement of institutional investors is a critical component of this adoption trend. As more established financial institutions, such as investment funds and asset managers, allocate capital to Bitcoin, it signals a maturing market. These institutions bring not only capital, but also sophisticated analysis and a demand for robust infrastructure, including secure custody solutions, regulated trading platforms, and reliable data. The development of Bitcoin-related financial products, such as futures contracts, exchange-traded funds ETFs, and other derivatives, further facilitates institutional participation by offering familiar investment vehicles. This growing corporate embrace of Bitcoin is also influencing regulatory landscapes. As more mainstream entities engage with Bitcoin, there is increasing pressure on governments and regulatory bodies to establish clear guidelines and frameworks for digital assets. This regulatory clarity, while sometimes challenging to achieve, is ultimately beneficial for widespread adoption, as it reduces uncertainty and provides a safer environment for businesses and investors. The impact of this corporate adoption extends to the broader cryptocurrency ecosystem. It increases Bitcoin's legitimacy, attracts more developers and innovators, and spurs the creation of new services and applications built around the network. As more companies integrate Bitcoin into their business models, it reinforces its position as a significant digital asset and a potential cornerstone of future financial systems. So, we've covered altcoin surges, mining plays, treasury strategies, and corporate adoption. What's the final word on this whirlwind of news? Let's do a quick recap of all the top stories and make sure you're subscribed. All right, everyone, that's a wrap on today's explosive crypto news. We saw altcoin surge as Cronos jumped 120% on a major partnership. American Bitcoin made its Nasdaq debut with strategic mergers. Companies are taking on Bitcoin treasury with high-risk, high-reward plays, and Bitcoin's corporate adoption is opening doors for institutional investors. Don't miss out on any of these critical updates. Hit that like button, subscribe to Bitcoin Bulletin, ring the notification bell, drop a comment with your thoughts, and follow us on all our social channels for more. We'll see you in the next one.